Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is your shareholders equity statement, one of the most important statement which every stakeholder or investor would like to take a look upon. Over here it says that Toshiba says it expects to book a $712.5 billion, it's yen, write down in its nuclear power business. That's one of its segments, citing cost overruns at a US unit, diminishing the prospects for its atomic energy operations. And this is the person who will be stepping down as the chairman of the conglomerate because it's operating in a different segment altogether. There's also a detail that has been given over here that more than $7 billion in market value as a result of the losses, and shareholders' equity will drop to negative 150 billion yen for the current year ending on March this particular year. So Toshiba is over here writing down its investment by 8.3 billion dollars in the nuclear power business in US, and this will result in wiping out the entire total shareholders equity of Toshiba. See, obviously this is a negative. As you know, the shares decline led to an erosion of more than closely to $7 billion in market value. So shareholders equity is the interest of the shareholders in the net assets in the, I repeat, shareholders is the equity, is the interest in the shareholder in the net assets of the company. So it is one of the most important aspect of the balance sheet, and there are so many other components which we need to take into account under the shareholders equity. So in this tutorial we'll learn the nitty-gritty of the shareholders equity. We'll start with what is exactly the shareholders equity. We'll start with what over here as the first. See, shareholders equity is the interest, as I told you, of the shareholder in the net assets of the company. You may wonder why, and I'll tell you the why. The assets of the company, they are either financed by the creditors or brought in by the shareholders. These are the two sources. Right. Now the creditors will be entitled to get paid till the extent they have contributed towards the financing the assets, and the rest will be enjoyed by the shareholders. So shareholders are valued more because they share both the profits and the losses. Now imagine that you have invested into a business. Now you would expect a mere return from the investment, if not more than your opportunity cost, and then business does not yield any profit. So instead it incurs losses. So as a result, you will not get actually any sort of return. So whenever a shareholder invests into a business, he takes risks of both the profit and the loss into account. Now that's why the shareholders are valued most in the business, and that's the reason the maximization of the wealth of the shareholders is one of the prime goal. Maximization of shareholders wealth. Now we can express the assets in the equation like this: assets is equal to your liabilities plus the shareholders equity. This is the equation by which you can go by. If we can interchange the equation a bit, we will get the definition of the shareholders equity in the formula as something like this: assets minus the liabilities will be equal to your shareholders equity. So the residual interest, that is the difference between the assets minus liability, is called the capital. And in sole proprietorship business, and the same is actually called as the sum of the individual capital. It is called as the sum of the individual capital in the partnership business. Now, there are some of the components of shareholders equity. Now, the first and the foremost component that we'll go by, let's start with the component. The component over here for the first and the foremost is going to be the common stock. Common stock. See, common stock is the first and the most important component of the shareholders equity. Common stockholders basically are the owners of the company. They are the ones who will receive the profits and deal with the losses after the company pays interest and dividends to the preference holder. So, and they will also get the most important, the voting rights. That's what they get. Common stock, if you want to find, then you can do it by common stock is equal to number of shares issue into the par value per share. There are two things that needs to consider here: the number authorized share capital and the number of shares that have been issued. So the number of the authorized share capital represents, you can see, the company can issue legally, the shares the company can issue legally, and the number of shares issued means the actual number of shares that have been company has issued. So this is basically legally and this is actually. Got it? this was the first part. I'll say the first part. Then let's see the second component, which is the additional. It is the additional paid up capital. Now, additional means more than the share price. So that means that when the company receives a premium on the shares, we would call it additional paid up cap. Now, additional paid up capital is basically your share price less the par value into the number of shares issued. Well, the share price minus the par value will come in one single bracket. This whole thing should come in one single bracket. Third is the preferred stock. Well, the preferred stockholders are the stockholders who have the security rights in the net assets, and they don't have any sort of voting rights, but they enjoy a fixed dividend even before anything is given to the common stockholders. So again, the preferred stockholders have been calculated as PS is equal to your number of preference shares into the par value of shares. Actually, par value per share. The fourth part is your retained earnings. Well, retained earnings are the earnings or losses that are accumulated from the previous period. In simple terms, you can call retained earnings are the amount the company keeps after paying the dividend from the net income. So this amount is reinvested into the company. Now, not only that, the retained earnings include your net income less any dividend paid and add or less any changes in the accounting policies that will give you the retained earnings at the end of the period. The fifth is the treasury shares. These are all the components. The component you should know it. Treasury shares is the sum of all the common shares that have been purchased back by the company. Treasury shares are the opposite of the common equity shares, and the common stock has a credit balance, whereas treasury shares have a debit balance. The sixth part, which is your accumulated other comprehensive income. Now, when we talk about this, accumulated other comprehensive income contains the unrealized gains or losses that do not flow through the net income statement. And examples are like, unrealized gains or losses from the investments that are classified, as available for sale or foreign currency translation, pension plan, and so on and so forth. So this were the part and parcel of the shareholders' equity. Well, this were the components. Now, I want to make you understand what are the reasons for the negative shareholders equity. See, in some of the company, you will find the shareholders equity is negative. Now, why is that so? See, there can be many reasons. The first can be buyback of shares. That can be the one reason. See, this is one of the most common reasons why shareholders equity turn negative. Now, if the company buy back shares, the shareholders equity portion gets reduced by the amount. So that is one of the reasons. Second is write-downs. Now, what is write-downs? See, write-downs could be another reason that can lead to the negative shareholders' equity. Most recent example is of Toshiba, which we learned invested heavily in the U.S. nuclear power business, and they realized that it will not give the returns as they expected earlier, and they took a write-down of whooping 8.3 billion in the businesses. So currently, Toshiba shareholders' equity is standing at 2.92 billion. With the huge write-down, so Toshiba's shareholders' equity will turn negative in that particular scenario. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.